Welcome to Mountain West IRA's monthly educational webinar. Before we get started, I just wanted to remind you that we love to educate and to expose you to ideas you may not have heard about before. But remember, Mountain West IRA does not offer investment, tax, financial, or legal advice to clients or endorse any investments. Individuals who believe they need that kind of advice should consult with a licensed professional. Always remember, look before you leap, and always, always, always do your due diligence. So now that we have the housekeeping out of the way, welcome again to Mountain West IRA's continuing drive to bring you education on investing, self-directed IRAs, and every topic that you have been asking for. Remember, during this broadcast, you can type questions in the chat or comments, depending on where you're joining us. And also, if you would like us to cover a specific topic in the next few weeks, just slip that into the comments as well. Okay, notes. You guys have been asking for this one for quite a while, and I am so happy to introduce you to our guest educator today. He has lots of information on this amazing alternative to hard real estate acquisition. So folks, this is Marco Barrio. Marco transitioned from a career in Hollywood TV and film industry to become a real full-time real estate and real estate note investor. Today, he is the president and the CEO, president and founder of Porch Swing Funding, which is a business that allows those owning seller-financed mortgages and notes to sell their future payments for cash. Marco's real estate path has included investing passively in commercial syndications, owning single-family rentals, and lots of strategies involving real estate notes. I have had so many requests for us to cover notes over the past few months. Marco, thank you so very much for joining us.
Thanks, Diana. It's great to be here. My last name's Marco Barrio. It gets jumbled into Barrio a lot, so I'll put that out there. But a great intro, and I'm impressed with this little broadcast setup you have here, and your intros and the studio. This is great. I'm really excited.
It's a lot of fun, and our clients and people who are thinking about self-direction, they send us requests all the time to talk about specific types of investing, because there's just so much out there. And the great thing about self-direction is you can invest in what you know and love. But a lot of times people don't understand just how many things are out there that they can invest in. And that's kind of why we do this. And thank you so very much for joining us today. So we're going to talk about notes, mortgage notes 101. So if you have not heard this term before, or if you are not quite sure what it is, this is a good time to sit back and listen. And remember, put those questions in the comments, and we'll go ahead and answer those for you live. So Marco, go ahead and take it away.
Thanks, Diana. Yeah, please put the questions in the comments, and I'd prefer to be interrupted as we go. I mentioned this to Diana before we started. I'd hate to cover something and for it not to make sense, because maybe it will make the things that follow it not make sense. So I'd rather be interactive, and I want to make sure everybody's questions are answered as we go. And we'll answer questions at the end as well. So I've got to do this too. This is an informational presentation. I'm not licensed. I'm not a real estate agent. I'm not an attorney. I'm not an accountant. I'm none of those things. I call myself a consultant. So none of the advice I give is tax or legal advice. I have lots of personal experience with this, but it is my personal experience. I always encourage people, especially when they deal with things like notes, which touch at times on consumer finance, and we'll touch on that in the presentation, to seek licensed professionals. And just because I say something doesn't mean it's exactly the same where you live or where you invest. So state and local regulations may vary, and they do, let me tell you. It gets very complex. At the high level, this is very simple, but if you speak with smart people and they're licensed and they know what they're doing, they're going to keep you keep you straight. So yeah, so I started in the TV and film industry. You've already heard my bio, so I don't really need to go into this, but I literally worked on television shows and movies for a long time. Every time I look at that 24 years, I think, God, this guy is old. But just to get to know me a little bit, I burned out on it, and the industry was changing. And those two things were happening at once. I guess call it my midlife crisis. So I started searching for something that I could do from anywhere. And at that time, and one of the reasons I'm really excited to give this presentation is I met somebody in Southern California, which is where I live. I live in Los Angeles, who was knowledgeable on self-directed IRAs. I'd never heard of such a thing before. I had money in the stock market. This was 5 years or so ago. And not because I was a genius, but because the stock market had done well since our last financial meltdown. And I benefited from that. But I started to feel, well, gee, I'm getting up there, and I don't want the stock market to drop 50% as it did the last time it dropped. And for maybe it's going to stick there for 10 years this time. Who knows, right? So in hindsight, I could have left the money there a little longer and made a lot more money over the last 5 years. But I started pulling that money out, and I'll share in a little bit. I started a solo 401k. So that's how I got started. That was mostly passive, quote unquote, passive investing. And then I started this business because I really didn't want to go back to a regular job. So I started Porch Swing Funding. And the thing I love about it the most is I deal with mom and pops who sell property and carry back a note. And we're going to talk about what that is. So because this is a retirement focused presentation, I want to share a little bit about my solo 401k. Diana can explain in detail what a solo 401k is and what the advantages or disadvantages are and who it might be appropriate for. But I have a solo 401k. I funded it with rollovers from a traditional E-Trade, in my case, retirement account. And, and remember, I worked in the entertainment industry, which is mostly freelance. So I didn't have a lot of traditional retirement assets, as many of you may who have regular jobs. I was mostly freelance for many years. But now today, about half of my solo 401k is invested in notes. They work really well in a 401k, in a retirement account of any type, whether it's an IRA, Roth IRA, 401k, et cetera. But what I started investing in were passive syndications, and I continue to hold those as well. So I feel diversified. And if you have questions about why I'm allocated the way I am and want me to drill into that, I'm happy to do so. So today we're going to cover notes. What are they? We're going to cover the types of notes. We're going to cover purchasing and creating notes. We're going to cover the ways to profit. And we're going to cover some case studies. Today is, I put this in here because I saw it on the internet today. Today is the Ides of March, which is the day that Caesar met his fate, right? The Ides of March. Beware the Ides of March. So here's Caesar, wink, wink, meeting his fate. However, did you know that the Ides of March traditionally was the date on the Roman calendar? March was the first month of the Roman calendar. The Ides of March, the middle of the month, the Ides, was the date on which people were supposed to settle their debts. So I think it's appropriate that today we're talking about notes, about debt, about the debt side of real estate on the Ides of March. So when somebody mentions a note, traditionally what they're really referring to are two documents. So as you start to get into what notes are in real estate, and what makes them magical in real estate is they're secured by real estate. At a very high surface level, Diana, if I write you a check for $100, that's a note. It's a promise to pay. That's a note. You can take that to the bank and they'll give you $100 from my account. That's a note.
Right.
But there's no security. If I don't have that $100 in my bank account, you got nothing. Sorry.
I get a fee when the check bounces.
Yes, you do. And I probably get an angry phone call from you. But in real estate, what's really cool is they have these things called liens. And these things called security instruments, which place liens on property. So when somebody does a search at the local county title office, they'll see, well, wait a minute. If it's the state of Idaho, there's a deed of trust that gets recorded that provides security for whoever holds the promissory note. So if there's a $100,000 note that I give to Diana and I'm a deadbeat and I stop paying, she can say, well, that's great because your house is worth $200,000, Marco. So I'll just go through the procedure and I'll get paid one way or another. Thank you very much. So that's the magic of real estate notes. Where else, what other investment asset classes are there out there where there's security for your investment, right? I think that's pretty powerful. So again, these two documents, the promissory note itself contains information like, just so you know what it is, it's a promise to pay, it's an IOU. It's like, hey, I promise to pay you back this money, that this credit that you extended to me, or this money that you loaned to me. So it's going to say how much credit was extended, who borrowed it, who needs to be paid back, what are the terms, and what happens if I default, right? That's what the promissory notes. I've seen promissory notes that are one page. I've seen them that are 3 or 4 in the seller finance world. They're usually not that, it's usually not that thick of a document. The one that's usually a little bit longer is the deed of trust. And by the way, I mentioned in Idaho, it's a deed of trust state. Others, and most of the Western states use a deed of trust. Most of the Eastern states use a mortgage. People talk about mortgages as a general term. Well, it depends what state you live in. I'm not going to go into the differences today. They're essentially the same. They both pledge the property as collateral. They both pledge the property as collateral. That's what ties the promissory note to the property. In there, usually, it'll state the responsibility for the payor, the borrower, to pay taxes and insurance. Got to keep the taxes and insurance up because guess what? Those are the things, those are the most risky items when you're a note holder, is if someone doesn't pay the taxes, you get in line behind the state or the county or whoever the taxes are owed to. And insurance, well, if the house burns down and it's not insured, it doesn't matter. You've lost your collateral, except for the dirt. The dirt doesn't burn. And the deed of trust or the mortgage is recorded with the county.
We do have one question real quick.
Let's do it.
They want to know if someone isn't paying their taxes, can you pay the taxes to take off the lien?
Yeah, absolutely. That's a really good question. As a lien holder, you have the right to protect your lien position. So in that example, if I have a first lien, a first position note on a property in real estate, and the taxes aren't being paid, I can do what's called an advance, and I can make the taxes current. And it really just gets added to the borrower's bill. Okay. So if 2020, they didn't pay their taxes, I was dealing with one of these today on one of mine. 2020, they didn't pay their taxes. 2021, they haven't paid the taxes current yet. I can go ahead and advance that. Sometimes it's called a corporate advance, and it gets added to their balance.
Nice. And he says, thank you.
Good, I got it. So there's this other thing. I mentioned a promissory note and a deed of trust, right? In a promissory note, deed of trust scenario, I sell my house to Diana. Diana takes title to the property subject to her note to me. Okay, she is on title. She has title for the property in that scenario. Of course, she still has to pay me back, right? Or I can go ahead and I can foreclose. A different scenario, and some people think this is seller financing. Well, seller financing is both, but contract for deed. In Iowa, you'll see contract for deed. In other states, I say here, AKA real estate contracts, land contracts, et cetera. You may even see those terms come up in Iowa. Really what they are is like a car loan. Remember when somebody said, hey, I got the pink slip to my car? Well, they paid off the loan, right? Hey, I got the pink slip. I don't know if they're still anymore, and I don't know if that's ever what they were. But you pay off your car loan and they send you the title in the mail. Essentially, that's just like a contract for deed. So I sell my house to Diana. except it's with a contract for deed. She doesn't get the title until she pays me the $100,000 or whatever it is I financed. Okay. So it's like a car loan. After she pays the $100,000 balance plus interest and all the terms that we agreed to, then by law I need to send her the title, and she gets the title and she gets the house, or she can go get a loan from someone else and pay me off. Now,
Awesome. I actually have 2 questions for you. Sorry to interrupt.
Go.
First one is from Sam. If someone files records 2 different deeds of trust, which one gets preference?
It's the order of recording. It's the order of recording. If at 3:01 p.m. there's a deed of trust recorded, and at 3:02 p.m. another deed of trust is recorded, literally, it's like twins, right? Who's older? Well, the one who was born first.
So don't dawdle. Get that puppy in there. I also have another one here.
So that's how they determine the order of preference is who gets recorded first. Usually, sometimes there's financing right when you buy a house where you might have a first and a second at the same time. They were more prevalent going into 2008. You don't see those as often anymore. But in those cases, they'll send instructions to the recorder. Please record this one first to make sure they get it right. They mess it up sometimes. But more likely than not, you buy a property and then you go get a second or a HELOC, and a year later or 5 years later, and that gets recorded, and automatically that's in second position because it's recorded after. It's a good question.
That makes sense. And the other one had to do with the contract for deed. So can seller financing be done as a contract for deed, or maybe installment contract, so that I keep the title in my name unless they finish paying? Sounds like what you were talking about right there.
That's exactly what it is. That's exactly what it is. People like those who seller finance, because rather than going through a full foreclosure, they're designed to be more like an eviction. It's almost like rent to own. Don't say that, because it's not that. At the legal level, it is. It's something a little bit different, but it's almost like rent to own, and the process to take the property back looks like an eviction more than a foreclosure. I kind of skipped over something on the bullet points here. They got a bad rap. So coming out of 2000, and you know how a few people kind of ruin it for the rest of us, especially real estate investors.
Always.
We try to do the right thing, but then someone gets greedy and they do terrible things. Well, there were a couple companies in particular coming out of the 2008 financial crisis, the great, what do we call it, the Great Recession. And they scooped up all these low-end foreclosed properties. And rather than, and I mean low end to the point that they were barely livable. And rather than put a little bit of investment into the house to make it somewhere that somebody would want to live, they sold them more or less as is, and they did it with land contracts and contract for deeds. Now, the problem with that was the people who were buying them were barely in the position to buy a house to begin with. And what they didn't have was money to fix up the house. So in this irresponsible way, they set a lot, we're talking a lot of families and individuals up for failure, to the level where it was recognized by state legislatures. So contract for deeds are changing, and it's state by state. In Texas, they virtually don't exist anymore. And in other states, they're tightening the rules they've always had certain limits as to, once the borrower acquires a certain amount of equity, you can no longer evict them. It really is a foreclosure. Mm-hmm. But they're getting harder and harder and harder to implement, and harder and harder and harder to take the property back. So yes, you can do that. Probably for the reason you were asking the question is why you would consider doing it. But talk to somebody knowledgeable about this. This is where I definitely would want you to seek some legal advice.
Especially depending on what state you're in.
Depending on the state. I don't know the rules in Idaho, and they're changing state by state very fast. So
awesome. And it looks like I don't have any more. So
okay. So that's CFDs, or contract for deeds. My least favorite slide. Coming out of the Great Recession, 2008, our friends in Congress, rightfully so, wanted to put some protections in place. Again, a bunch of greedy people wrote a lot of loans to people who shouldn't have had loans. They could fog a mirror, they got a loan. Congratulations. Well, until the point that you have to make the payment, right? And there were a lot of problems. So the Dodd-Frank Wall Street Reform and Consumer Protection Act, I think it was passed in 2010, and it didn't go into effect until 2014 because it took that long for people to actually understand what the law meant in order to be able to implement it. And it established things like the CFPB, right, the Consumer Finance Protection Bureau. So it's big legislation. The problem for people who seller finance, and this presentation, by the way, isn't just seller financing. I work in that space, so forgive me for bringing it up so often. But the problem for people who seller finance in particular is that we just got wrapped up under the term lender. Hey, anybody who sells a house and puts debt on it, they're covered under this. Well, there were a few exceptions. What it set out to do is establish, it says here, licensing, loan term, and underwriting guidelines. At the high level, don't put people in homes with loans that they can't afford to pay, or you're going to be in trouble. Okay.
Right.
So there are a few exemptions, and I won't go into all of them here, but if I want to sell my house to Diana and I'm only going to do one of these a year, there are enough exemptions that I'm going to be fine, right? The number of deals per year. If I'm an investor and I might have 2 or 3 houses a year I do this with, I'm okay, but I've got a few more restrictions. So the limits are set up under deals per year, verifying the borrower's ability to repay, and using another thing called residual income, terms and special features, balloons, varying interest rates, things like that became really popular in 2005, 6, 7, 8, et cetera, because, gee, we can start someone out at 1% and then jack them up to 9%. Well, boy, the payment sure is going to go up. Is their income going to go up? I don't think so. But no one thought of that, right? So now Congress has thought of that. And then there's variations depending on, again, back to the state you live in, because some states have their own regulations on top of Dodd-Frank, but the entity. This isn't to scare anybody away from this type of investing. This is something to be aware of. It only applies to owner-occupied properties. Always, 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 when you're investing in notes, think, is it owner-occupied or not? If it's owner-occupied, just walk more carefully and seek more opinions about the things you do because you're in the consumer finance space. Mm-hmm. Think like a legislator would, who's protecting their voters. Do they want to see people kicked out of their homes? No. So that's Dodd-Frank. Are there any questions about that?
Not on Facebook and not on YouTube.
Good, because I'll refer you to my attorney. Types of notes. Now we get into the fun stuff. Is everyone still with me? I love this. I'm like the note nerd. How long do we have? 3 hours, 4 hours? I'm good. There are 3 buckets of notes, if you will. Diana goes to buy a house and she calls Rocket Mortgage, which is part of Quicken Loans, and they give her a loan. That's an institutional loan. By the way, I find this interesting because I am a nerd about this stuff. Those lenders you see there, I'm just curious how many of those you've heard of before, first of all. And I want you to notice how many of those are banks. Those were the top 5 mortgage lenders, institutional mortgage lenders in the United States in 2020. The 2021 report won't be out until about August. That's when they send this report out every year. But those were the top 5. So it's interesting. You don't see a lot of banks lending anymore on properties. Why? There's a lot of regulation there. It's a little bit harder to make money now. So you've got these wholesale companies, and we won't get into that, and non-bank lenders because they have to follow fewer regulations. Okay. So institutional loans you'll find in the marketplace non-performing or re-performing. That's how I started investing. I started buying non-performing paper, non-performing notes. People who defaulted, more likely than not, coming out of the 2008 to 2010 period. And it's like a house flip. You're buying something that needs either to be modified, or there's sometimes take back the property. But the ones that need to be modified, there's an opportunity there because it really is like a house flip. It's okay. Well, they haven't been able to pay their $700 a month mortgage payment. Maybe I can do something. Maybe I can forgive this back debt or put it onto the back end of the loan, and we can update the terms because, gee, it's 12% now. I mean, who did that? Who in the right mind thought they could pay that? I bought it at a discount. I have some cushion. That's a strategy with the buying non-performing institutional paper. It's to buy it. Back in the day, it was pennies on the dollar. It's not anymore. That's part of the reason I don't do it anymore. Also, I don't like it as much as what I do now. But that's a strategy. It's to buy the dent and scratch stuff, fix it up, try to get it to reperform. Or there's a strategy. It was never my cup of tea. Is that's a way to acquire property, right? We're going to foreclose. We're going to take back the property. It's a way to acquire property. That's institutional paper. Private money lenders. I see probably the most IRA note investing in the private money world. Especially a lot of people in my real estate investor community are lending on fix and flip. They're lending on fix and flip. There are all these investors out there who, if you feel good about their skills and their ethical business practices, and you want to lend to them, you're not lending on owner occupied. Remember, I use that caution. You're in and out of those deals pretty quickly. But you just have to be confident that these people know what they're doing. Hard money is essentially fix and flip loans. Investor funds, maybe it's somebody who's going to do buy and hold for rentals or short-term rentals, long-term rentals. Again, lending on non-owner occupied property, because you're not seller financing. This isn't you selling your house. This is you lending to somebody else. Even more rules. So be very cautious if you're going to lend on owner occupied there. Bridge financing, etc. Again, be careful of owner occupied. Seller finance. This is the stuff I love. I love it because I'll tell you a little bit about what I do. I market to mom and pops who sell their house and they carry back the note, right? They carry back financing, seller financing. So I end up dealing with, this is the part I love, a lot of 55 plus, because 30-year-olds, let's face it, could barely afford a house these days, let alone have owned it long enough to sell it. So this is the house that they used to live in, and they sold it because they wanted to live closer to grandkids. Or people call me because their dad and their parents had sold this house and they'd been collecting on the note, but they passed away. And now 3 siblings inherited a note. And first of all, they don't want to split the payments 3 ways because that's a pain in the butt. Second of all, every time that payment comes up, it reminds them of their dad who just passed away or their mom who just passed away, and they'd rather just move on. So I deal with people at that level, much different than foreclosing on people who didn't pay their loan, right? Their institutional loan. So that's what I do. There's an inventory in the marketplace of those notes. You can find there's people like me who will bring these deals in and they become available to others. Some of my deals are funded by banks, others individual investors. It's just I'm kind of a matchmaker when it comes to that, and others I hold my own portfolio. But that's that. Investors do this too. They buy a house and they fix it up, maybe a fix and flip, and then they sell it with financing, and you can pick up those notes. And I already covered this, but Dodd-Frank does regulate the seller finance world, but there are exemptions. Mm-hmm. Any questions on that? So those are the 3 buckets of notes. Okay. Now, I should have done this as a grid, but there are 3 kinds of notes. So let's call these our buckets: institutional, private, seller finance. And then let's call this the different kinds of whether they're, performance level. I should have come up with a term. But a note can be performing. And to me, that means there are no payments more than 30 days late. Okay. Sometimes notes go non-performing, which if you look over to the right is 30 days or more late. And then the borrower, either because somebody's worked with them to get them caught up, or they just on their own manage to bring it current again, then it becomes reperforming. Different investors call this different things, define it differently. I like to see 6 or 12 months since any payments have gone beyond 30 days.
I imagine in 2020, when everybody was stuck at home, not working, probably had a lot of people who had trouble paying. And then once they got back to work, they started paying everything on time again.
Yeah, less than I thought I would see. And many of my many other investors in my network saw the same. People tend to do what it takes to make their housing payment. Plus, we had a lot of help out there, right, from government, from PPP money to unemployment and et cetera. So it was less than I thought. Thankfully, less than I thought.
That's great.
So, okay. There are two ways to get notes. You can buy them or you can make them. You can buy them or you can make them. Buying notes, you do it on what's called the secondary market. If you want to sound like a big shot, hey, I buy my notes on the secondary market. No, I buy mine at Walmart. No, you buy on the secondary market. Where are some of these places you can find notes? So we're talking about existing paper. Again, more industry stuff. You're buying existing paper, whole notes, blah, blah, blah. You're buying stuff on the secondary market. There are a couple websites out there where people list notes for sale. I like to, every now and then, it's like a flea market. Every now and then you find a little gem and you pick it up, right? Most of them are overpriced. However, paperstack.com, notesdirect.com, what's really fun about these is you can window shop and you can practice underwriting. We're not going to go into underwriting today, but you can look over these deals, and I still do this. Again, I'm a note nerd. I still do this. I run the numbers. I check out the collateral. I wonder, try and get the borrower story and figure out if there's someone who's going to continue to perform or if I can get them to reperform over and over and over again to get better and better and better at it. I practice. That's how I learned this. Again, I used to make movies and TV shows, but now I do this. I practice. And it's a great place to see inventory and ask questions from the sellers. They'll answer them. And look over the collateral and ask questions to people like me or others who, if you don't know the answer, it's a great community and you'll find a lot of help out there. I market to mom and pop note holders. These are the, people who carry back paper when they sold a property. Investors who sold property and carried back paper, brokers, people like me. Hedge funds, you'll find, here's what happened. All these loans went bad in 2008, 9, 10, et cetera. And a lot of individual investors first found this space and were buying them. I'm not kidding, at 5 and 10 cents on the dollar. I wish I were in the business then. I can't say I was. Then Wall Street found out about it, and Wall Street money came into it. And the big note pools, a pool is a whole kind of a pile of notes that hits the marketplace all at once from a single seller. It's called a tape or a pool. You'll see people like Goldman Sachs bidding on those. And that's at the high level. But you can imagine below Goldman Sachs is a slightly smaller firm, and then a smaller firm, and then a smaller firm. They're all hedge funds. They're all using other people's money, whether it's pension funds or accredited investor funds, et cetera, to buy at bigger discounts because they're buying in bulk and they're buying further upstream.
I do have a question from Les. How do you find the mom and pop note holders?
There are two main ways to do it. I market online and haven't done it in a while, but you can send direct mail. I recommend sending direct mail if that's how you want to start. I mean, as you're getting started, because I've spent many seminars worth of money on Google Ads, I'll tell you. And it takes a long time to get that dialed in. There aren't many of us who do it. It's such a specialized and niche space. But I started by sending letters and postcards. Scott, look up the name. I can't remember the name of his website, but there's a guy out there named Scott Arpan, Arpan. And if you Google him, or Scott Arpan Notes, he has a website that sells list of note holders. He's been doing it. I think his father did it before him. He's been doing it for years and years and years. That's where I used to buy my list from. And there are a few other companies out there who sell them as well. The reason those lists are available is because, again, notes, deeds of trust, and mortgages are recorded, and so are contract for deeds and land contracts. They're recorded, so it's public information. And believe me, people get my letter and call me and say, how'd you get my information? Well, sir, from the county records. That makes them so mad. But the companies who sell these lists, they cull out the stuff that says Wells Fargo and Quicken Loans and et cetera, all these big outfits. And what's left are, Bob and Jane, Jones of, Boise, Idaho, or, whatever. And those are going to be the seller finance ones. So those are the lists that you're buying. That's a good question.
Awesome. Data mining at its best.
Data mining at its best. I mean, you're welcome to go look through the county records and call your own records too. But the lists are really pretty cheap. You're talking 5 or 10 cents a lead. They're pretty cheap.
That's awesome.
The place that you're not going to find notes these days really anymore is calling banks or credit unions. You'll still hear a guru or two talk about this. They're living in the past. The reason is the banks and the credit unions and so forth, they only want to talk to the big funds because they feel safer working with them, because they know that they aren't going to do things that are illegal in the collection process that's going to blow back on them. They can't afford to. These are federally chartered banks and credit unions and so forth we're talking about. They can't afford to mess around with the little people, frankly, like me, like us. So They don't sell to us. They want to sell to big firms. And then eventually what happens is it can filter down into the smaller players, but you're not going to get inventory from these guys. Maybe a local credit union where you have a relationship, but it's at a very small scale. Now the fun part is creating them. As a retirement investor, you can fund loans. You can be a private lender, you can be a hard money lender, fix and flip. You can lend on people's buy and hold rental property. Let's say an investor wants to start or has an existing, even better, short-term rental business, and they need funds to acquire more houses and to furnish more houses. You can lend on those. And I'm really focusing on real estate here, but the other thing you can lend on are small businesses, right? Somebody wants to start a car wash or buy a car wash or a hair salon or, you name it. Talk to people knowledgeable about this, but there is some security in those, especially if that business owns the real estate. If they're going to buy a business and own the real estate, you can be secured by real estate in that transaction. And it's not a bad place as an IRA investor to loan because it's passive. You're not going to operate the business. You can't do that on your IRA, but you can lend on it because it's completely passive. And then finally, if for one reason or another your IRA ends up owning property, you can sell it and you can carry back the paper. So how can you make money? Oh, I want to talk about partials. A note is nothing more than a stream of payments. So let's say there are 100 payments on a note outstanding. You don't have to sell them all. You don't have to buy them all. You can buy some of those payments or sell some of those payments. Those are called partials, like the piece of pie here. Right? You can sell the whole pie or you can sell it by the slice. When you buy a partial, it's like a first on a first. So let's say I buy a note from somebody, one of my mom and pop note sellers, and it has 100 payments remaining. But Diana has a little bit of money in an IRA or one of her kids' IRAs. And I don't know if you have kids, but someone's kids' IRA. And you want to make a little investment with that. I can sell her 40 payments. I could sell her 50 payments. So she can take a smaller bite, but also guess who gets paid first? Diana does, because she bought the next 50 payments. So in that way, it's like a first on a first. So if something happened and the loan kind of went belly up and we went through a foreclosure, the partial agreement states that Diana gets paid before I do. So it's like a first on a first. It's a great position. If you ever find yourself unsure about the equity protection, right? So the $100,000 note, gee, the house is only worth 125. I know not where you live, not where I live either, but gee, the house is, I'm not so sure I like that loan to value ratio. Buy a partial. Invest $50,000 or $25,000 because there's all that protection above you. It doesn't matter that there's no behind you because you get paid first.
That's awesome.
Yeah. And I've got a couple case studies here. When you sell a partial, you can recoup all or a good portion of your investment. So you can buy a note for $50,000 and you can sell the partial for $35,000 or $40,000 and still keep the back end of it. And you'll see this in the example. You can end up making a lot of money with only a little bit of money invested. And that's, partials are amazing, amazing. So how do you make money? Buy and hold, meaning buy it and collect the payments. Buy and hold, just like owning a rental. Buy and hold, but way more passive. No tenants, toilets, and termites, right? That's the
right.
No tenants, toilets, and termites. No one calls you when the toilet is clogged when you own the note. Buy low, sell high. It's like buy and hold, but I buy it at a discount. I sell it at less of a discount to somebody else. I think you're limited how much of that you can do inside an IRA. You want it to look like a business, but anyway. Sell partials. I just covered that. Hypothecate. Hypothecation is, and I have an example of this, hypothecation is a loan secured by an asset. Sound familiar? A loan.
It's like a non-recourse loan.
A loan secured by an asset. Exactly. Exactly. Like a non-recourse loan or a car loan or, all sorts of loans. So your note is an asset. Why not go to somebody who will loan and give them the security of your note? That's called hypothecation. And I have an example of that. Exchanging. For those who aren't familiar with exchanging, cash is only one way to acquire property. You can trade your mobile home for a down payment on a property. You could trade your boat for a down payment on a property. You could trade piano lessons for 10% interest on a property or an option on a property. There's a whole world of exchanging out there that I won't go into. It's incredible stuff. Note payments are great, a great commodity. Somebody might not want cash if they're selling a property. They might be happy with monthly payments, right? So, hey, here's 50 payments on this note I own, or here's this whole note I own. There's 100 payments there. It's yours. Great. Here's the title to my house. Pay me the rest. We'll do a note. You pay me the rest over time. It can get super creative. I recommend everybody here put this in Google. Not right now. Listen to me. But after this, Google one red paperclip. If you've never seen this video, it's about trading. This guy starts with one red paperclip and he ends up with a house.
Wow. That's
trades
awesome.
his way up, trades his way up, trades his way up. Before you know it, he has a house. It was an ABC 2020 story they did.
That sounds great. I do have a question that came in.
Okay.
If you sell a partial and there is a default on the person you sold the partial to, who's responsible for the foreclosure on the default?
Yeah, put that that goes into the partial agreement. There's a partial agreement, and that can be negotiated. Generally, my advice is the person who's more knowledgeable to handle that, to manage it. In my case, I've managed foreclosures before. I know I'm not afraid of them. I would try to stay involved in that part of the process. The other part of that is who's going to pay the cost. Well, a lot of the foreclosure cost should come back to the lenders, right? So if there's $50,000 balance outstanding, but you had to spend another $5,000 on the foreclosure. Ultimately, you're due $55,000. There are a few miscellaneous costs that don't get reimbursed, but big ones like legal fees do get reimbursed. Does that answer that? Okay. So one red paper clip, I recommend it. Case studies. Are we okay on time? I know I'm.
Yep, we've got about 15 minutes left.
Okay, let me fly through a few and then I want to do any other questions. Buy and hold, right? This is the rental model. Notes are usually bought at a discount. I think I forgot to say that. It's pretty important. But on the secondary market, this magical place, we don't pay par. We pay below the balance. Par is there's $75,000 due on the note. You don't usually pay $75,000 for the note. Usually you buy it at a discount. What does that do? Well, look here. $75,000 note written at 7%. The note says 7%. That's what the monthly payment would be. It'd be about $992 a month for 100 months. That's 7%. If I pay less than the loan balance, my yield goes up. It's magic. It's magic. Learn the financial calculator. It's magic. You can do so many things with this. So you can make a higher yield. That's what happens when you buy and hold. You buy with a discount. And please ask questions as I go through. Okay. So pay attention when I click over here. The only thing that changed, same current note, same buy low. Those are the same as the previous slide. But what would happen if then I sold to somebody else at a smaller discount? They still got a little bit of a discount, but I just made about $10,000. I bought a $75,000 note for $62,500, and I sold it for $72,235. It's almost $10,000.
Almost like wholesaling.
Yes, it is. Yes, it is. But you actually took ownership of the note there. Yes, it is. It is a lot like wholesaling. Yes. Buy full, sell a partial. Same current note, $75,000 at 7%. I'm going to buy that baby for $62,500 and get a 12% yield. But, and this is where partials are cool, but I'm going to sell 65 payments, not 100. I'm going to sell them at an 8% yield. So that this person, I found the note, right? I found the deal. So I got a little bit extra from it. So the buyer is happy with an 8% yield. I checked, Wells Fargo's at 0.01% right now, I think, in their savings accounts. Someone should be happy with an 8% yield. They should really be happy with less. So 65 payments sold at an 8% yield happens to be $52,000 and change. Okay. So how much do I have in the deal? About $10,000. After the 65 payments are received by the partial buyer, I'm still due $31,000. So I have $10,000 into a deal where I'm going to make 3 times my money down the road. I just have to wait. Partials are pretty cool. Okay, sorry for this one.
Sorry, one more question just popped up.
Go.
In a partial, who owns the note, loan, lien?
Yeah. No,
I couldn't figure out what to call it.
I understand the question. I've seen it done both ways. I assign it to the partial buyer. Okay. So when, Diana, if you write a check to me for $100 and I can go to the bank and I can cash the check, or I can endorse it to somebody else, right? I can flip it over and say pay to the order of. That's actually how we endorse a note. It says pay to the order of, believe it or not. So that's called an endorsement of the note. And remember, there's 2 documents. The other document, the deed of trust, you do something called an assignment. So I endorse and I assign everything over to my partial buyer. So they have control over the asset. That's the way it should be done, in my opinion. It's the right way to do it. You will see some people who retain ownership of the asset, retain assignment of the asset, and then just use the loan servicer to divert payments to the partial buyer. But if I get hit by a bus, I want that person to have control of it. I mean, that's,
Right.
that's the long and short of it. So that's a common question you asked, and that's a good question.
Awesome. And I don't see any more questions. So,
all right, here's the advanced class. Hypothecate. Same current notes. $75,000. Oh, I'm sorry. I messed around with the numbers here to make more sense. $75,000 at 10%. Okay. I pick up a note, 75,000 at 10%. May have been written at that, or it may be that I bought it at a discount to achieve a 10% yield. Okay. I go to somebody, could be someone with an IRA, for instance, who lends against my note. And I pledge my note as collateral, just like you can pledge a house or a car or rare baseball cards as collateral. I pledge my note as collateral. If I stop paying you, here's the note. We'll put it in escrow somewhere so you can get it. You can start collecting on this note, right? So the lender funds a loan. Now, I wouldn't expect the lender to, just like you don't lend on a house 100% loan to value, I wouldn't expect a lender to do that with a note. So I think I did this at 60% or 65% or something like that. So they loaned me $45,000 at 7%, making a good yield, and they're secured by something too. That's pretty good. So I'm going to pay them $992 a month. I'm receiving about $1,100 a month. So already I'm making a little bit of money, but just a little bit of money. But the $45,000, I'm going to go buy another note for 50 payments, a smaller note for 50 payments. And then at some point, probably around 40, but let's say all 50 payments come in, I'm going to go buy another note. I'm going to reinvest. So for 100 payments of time, I've now made 10% using their money, which I'm only paying 7% for. Cost of funds they talk about in the banking world, that's my cost of funds. Now let's compare those two. If I just held the note and I collected $1,100, $1,108 a month for 100 months, I'd collect $110,836. Ultimately, my return on investment overall would be 48%. Okay. Mm-hmm. But I juiced it because I did this hypothecation. This is how banks work, by the way. This is how banks work. I made $116 a month on the spread between what I owe the lender, what I'm collecting from my borrower. Okay. So $11,000, that's not much, 11,600. But these two notes combined, 50 payments and 50 payments, were another like $110,000. Total, I collected $122,000. My IRA, instead of 48%, my ROI rather, instead of 48% was 63%. Took some work and it took some financial knowledge, but this could be done in an IRA. I think, right? I don't give advice on these things, but I think so. So any questions about that or any of the other case studies?
I do have a question. Have you gotten a legal opinion on selling to an IRA a note and separating out the deed of trust? And in hypothecating the note without the underlying asset.
So is that two? I think that's two questions.
It is two questions.
Have I gotten a legal opinion on selling to an IRA? Well, I've sold to IRAs.
Well, the first question is, have you gotten a legal opinion on selling to an IRA a note and separating out the deed of trust?
Well, I don't separate the deed of trust. They're BFFs, right? They always go together. So the note is secured by the deed of trust. And the IRA, I don't sell to Bob or Susan or whoever. I sell to the IRA, which the beneficiary of is Bob or Susan or whoever. And the IRA, there's a purchase and sale agreement, which defines, the sale of the asset. And then underlying to that would be the promissory note and the deed of trust. Promissory note gets endorsed, deed of trust gets assigned.
Okay. And then, And then they were just reiterating the same question in a slightly different way. So,
Well, there was a question about the hypothecation.
It said in hypothecating the note without the underlying asset.
Oh, okay. Yeah, I would never hypothecate without. Again, the note is standing in as collateral, just like a house is collateral or a car is collateral. The note is collateral. And when I use the word note, pardon me, but when I use the word note, I really mean the deed of trust and the promissory note.
Okay, that makes sense. Did that answer your question? And I think we're good. Okay.
Okay. That's all I got. That's my contact information.
Okay. Let me look around here real quick, see if we have any other notes or questions. Yes, I have one here from Amy. When you buy a note, is it always as is, or can you set new terms or renegotiate it if it is not performing well? So
Understood.
I'm thinking that she might be talking about when you go to one of those websites and you buy a note.
Mm-hmm.
Yes,
Mm-hmm.
yes. So
Well,
if you go out to a site and you buy a note, is it always as is, or can you change the terms if it's non-performing?
well, let's think this through. Let's start kind of with one and move into the other. If I buy a performing note, all that's happening, go back to what I was just saying. I tell people when people call me, these mom and pops, to sell the note, they usually ask, well, what's going to happen to the person making the payments? Will anything change for them?
Mhm.
And I say the only thing that'll change for them is where they send the payment. I can't legally change it unless I negotiate with them. I can negotiate with anybody. You and I can make an agreement and then in 6 months say, hey, this isn't working out so good. What do you think? Would this work better for you? This might work better for me. And we can modify. It's called a modification. We
Mhm.
can modify the agreement. Okay. But you can't do that in legal terms unless both parties are in agreement.
Okay.
Okay.
So
So
it's not something you can force on them. It's an agreement, a new agreement that you have to come to together.
exactly. So in the case of this non-performing, just to expand on that a little bit, there probably is a benefit for the borrower. Maybe they're at 12% and they just can't make the payment. And there's a benefit for me because, gee, I bought the thing at a discount. I've got some room to negotiate here. I want this person to be successful because if they're successful, I'm successful.
Mhm.
So it opens the door to a negotiation. That's a loan modification.
Awesome. Okay, let me see if I have any other questions here. Nope, I don't. Okay, got just another minute, folks. If you have any questions, go ahead and put those into the comments. And if we don't see any, we'll go ahead and
I do want to mention, I want to point to this slide I have up, this where it says seller financing newsletter.
uh-huh.
Um, I started 2 months ago now. Diana, you've seen my newsletter. A newsletter that comes out every Sunday. I happen to think it's great. As egotistical as that sounds, it's really simple. It's 2 tidbits every Sunday about seller financing. Little tips, little tidbits, little things that might lead to more questions, which I'm always happy
Yeah,
to
that's
answer.
actually how I met you, Marco. Somebody shared your newsletter with me, and I went, "Ooh,"
Yeah,
and
that
that's
brings
when
you
I
in.
went ahead and emailed you, and we got to talking. So yeah, it is a very good newsletter. Oh, then Gina says yes, the newsletter is great, and Gina, thank you for sharing that with me.
Hi, Gina.
Okay. All right. Well, let's see. Marco, my gosh, thank you so very much for joining me. Folks out there, if you're actually catching this on the replay and you have questions, please go ahead and contact us using the information that we are going to post in the comments. And if you are listening to the podcast, you can reach us by going to mountainwestira.com, emailing us at accounts@mwira.com, or even calling us at 866 377 3311. If you're catching this on the replay, be sure to like and follow us, and then you can be notified of upcoming free education as well as live events. We will see you all very soon. Marco, thank you again so much for joining me. And folks out there, remember, be well, be safe, and always remember to pay yourself first. Bye.